historically, when you go back and look at probably the last 4 decades, is the seventh or sixth or the sixth, seventh, eighth year of a decade, what as a treasurer needs to be worried. Just no correlation. But if you go back and look in the history, it's 86, 87, we had the option crisis. 96, 97, we had the Southeast Asian crisis, the currency crisis. 2007, 2008, we have got the Lehman and the subprime crisis. And again, 17, 18, we issued, the hard landing of China and everything else. But this time what happened was, if you look at it, the pandemic which hit us in 20, so that's like once in a 100-year pandemic. And whenever this kind of event happens, the aftermath, the impact of these things would actually come with a lag effect. Now, to give a perspective, 65% of the dollars what you see were printed in the last 2 years. That's unprecedented.
Yeah, it's incredible.
Now, at the end of the day, it's the liquidity which will define the fundamentals. It's not the fundamentals will define the liquidity. So basically what I'm trying to say is that as a unprecedented liquidity was released in the system, many people started believing this is going to be the status quo for many years. What followed is an unprecedented amount of inflation, right? Whenever the central banks expand their balance sheets, it increases the valuation of assets. So basically, when the valuation of the assets goes, of course, the rich holds the most of these assets. So the rich is happy. The poor gets a free buys. They are also happy. But who's going to fund that expansion in the balance sheet? Somebody is going to fund it. And that you can achieve by taxing the middle class. Now, unfortunately, the inflation keeps on going higher. You will not be left with any of this middle class. So essentially what you are looking at is a situation where you cannot escape. So first, we saw an unprecedented amount of easing of the liquidity, which increased the valuation of a lot of these asset classes. And then we saw a sharpest rate hike ever in the history of the central banks, like moving from 0% virtually, ZIRF, which is zero interest rate policy, followed by a quantitative easing to a 500 basis points rate hike in a span of 14 months. Now, the market has not got time to adjust into it. So basically, typically, when the rate hike happens for 25 or 50 basis points, market takes 2 to 3 months, and then it gets into the new normality. So when the rate hike is up to 500 basis points, unfortunately, the market has not got that time to readjust or rebalance to this kind of rate hikes. Now, this is the situation. So it's not possible for any central bank or any economist or any treasurer to predict how it's going to hit you in the future. If you ask me today, is this the end of the rate hike cycle? Probably in the war against inflation, Fed or central banks, we believe, are eventually going to win it. But even if you still look at the service-led inflation, which is the core, that has not come back. So you're still looking at inflation not coming down to the 2% target, what has been set by the developed economies. Of course, emerging economies, it is much better. So what I'm trying to make it is that the low probability, high impact events, those have started happening much, much, much faster. So previously, when you used to model and your stochastic model or your quantitative models or your VAR models, you're probably modeling it around 1 in a 10, which is your 90% VAR, or 1 in a 25%, which is 1 in 25, which is 99% VAR. So the historical concept doesn't stand right now. So for that reason, we have seen unprecedented volatility across asset classes and currencies. But last 8 months, what we are experiencing is there is a cool off in terms of the commodity prices and cool off with multiple things which is happening. So this situation, extreme volatility, unprecedented rate hikes, coupled with a lot of rumor mongering, or you can say the trust factor, which is playing major in terms of the market players or the market makers, which has led to failure of many things. Is it the end of the things? Probably not. I'm not sure, how many coffins will be opened and how many skeletons will walk. So that's where we do stand. So it's may not be, inflation is still not under control. So you're still going to leave with some kind of volatility, unless it's the equity market which is going to do well or the debt market which is going to, do well. So unless we do not see accidents like, other banks keep on falling, Fed is not going to stop, or Fed is not going to give any signs of easing. For that reason, either if the accident happens, of course, they have to react. So either one of the markets is going to do well. Now, just small example in terms of equity. If you look at the stocks in US right now, because I'm giving a lot of anecdotal evidence to US, the companies are operating not only at the EBIT and PAT level, they're operating in 1 or 2 year high. They're operating at 50-year high levels in terms of the EBIT levels and then the PAT levels. So margin and PAT both are at significantly higher levels. So here I come to the classic saying of the Jack Welch: if the rate of change of the external world is faster than the rate of change of the internal world, end is near. So you need to be very, very agile, nimble-footed to keep your risk management practices up to the mark. Now, we as Wipro, we operate roughly around 40 odd countries. We are operating at around 25 active currencies. If you ask me today, what is my strategy? There is no strategy. There is nothing called as strategic, because if a central banks are not able to see how the inflation is going to behave, it's nothing but just going by your gut feel to see where the inflation is going to head it. So everything is tactical. And I cannot, we cannot believe, one so fits all kind of policy. But very clearly, if we see some countries in our portfolio which are exposed to significant amount of risk, let's take the example of Israel today. What is happening in Israel? This is an end kind of conflict between the government and the Supreme Court or the apex court. How we are going to look at the rights of the people, or how you're going to look at the political rights. So we are not very certain about the country. So maybe we can take a longer term call in terms of hedging our currencies. But at the same time, if you ask me, the hedges are something which are not very mechanical for us. Of course, we are exposed not only to the currency risk, to the interest rate risk, to the commodity price risk, to the political risk, to the tax risk, of course, and of course the operation risk. So it's a combination of everything else. But we are very clearly, we are keeping in track of what is happening locally and what is happening at a central level. So how you are looking at the big picture, what is our risk taking ability in those countries. Maybe euro is one currency where you can take, you have to be very, very particular. Israel probably, in a shakil will not take any view. We'll just go and hedge our this for a longer period for 3 to 5 years. It depends upon what is the kind of our risk taking ability or is risk tolerance level. So the point what I'm trying to make is that we as a treasury, we are not a risk-averse treasury. We are a risk-averse treasury. We should know how much risk we are taking and how we are optimizing the risk to reward ratio. So that's on a broad concept. The two questions what you asked: how do we see the risk per se, and number two, as a MNC, what are the kind of risks we are exposed up to. But one key change I'll give one expose. Previously, if you asked me 10 years back, do you see completely coming out from a country? The answer is no. But today, with the pandemic, there is a rebalancing of the tables. So you need to be very particular because of the supply chain issues and all. What are the countries you want to operate and what are the countries you want to pull off? So for that reason, hedging not only your trade related current account risk, but your capital account risk, which is nothing but your equity, that becomes very, very, very crucial. So we are doing that proactively, how to hedge your capital account risk. So basically your overseas direct investments and your equities. That plays a major role in terms of our risk management strategy specific to the currency part of it.